Hello, everybody, and welcome back. Asia represents a huge universe of potential investments. Small caps, in particular, are considered under-researched and overlooked. Today, we talk to Vivek Tanneeru, portfolio manager of the Asia Small Companies Fund at Matthews Asia, about investment opportunities and risk for Asian small caps. A warm welcome to Vivek.
Thank you, Thomas. Great to be here.
Vivek, the inflationary environment is lasting longer than everybody expected. So meanwhile, fears of recession are spreading. Why should investors consider Asian small caps right now?
A great question, Thomas. What I find very interesting is the fact that inflation is a particularly Western phenomenon in this cycle. Allow me to explain. Inflation is a concern in the US and in Western Europe, to a large extent driven by this extraordinary stimulus that was administered through the COVID pandemic. That's really resulted in excess demand, also partly exacerbated by the fact that there were supply chain shortages. Now, if you take a closer look at emerging markets broadly and Asia in particular, the amount of stimulus that went into these economies was very, very low comparatively. So therefore, the inflation impulse in those economies has been fairly subdued. And in some economies where this has been an issue, the central banks really started increasing rates pretty early on. And part of the reason is that these economies have always had to deal with inflation. Unlike US, for example, which hadn't really seen high inflation for about 40 years. Therefore, the central banks in some of these Asian countries were nimble in increasing rates, and therefore you actually had a situation where there were strong real interest rates on offer in some of these economies. So I'd say inflation is really a less of a concern for Asia. Now, talking about recession, that again is less of a risk for Asia. Economies like China and India are expected to grow, north of 4%. India much higher than 4%. And you have economies like Indonesia and Philippines also growing quite well. So broadly, inflation is less of a concern or not a concern really in Asia. And also recession is not a worry. So therefore, we find the environment to be fairly conducive for small caps, led by two things. One, as we're coming to, part of the cycle where inflation is cooling off, we expect the margins for small cap companies to improve as the raw material and input costs go down over the next 6 to 12 months. And the second piece really is that small companies in Asia are less impacted by some of the regulatory challenges that large internet platform companies in China had faced, for example. So therefore, I think for those two reasons, I find small caps to be a good place to be, given the inflation backdrop where it's coming off the top, as well as the fact that we don't see a recession in sight in Asia.
Following the euphoric celebration of China's reopening earlier this year after the COVID-19 lockdowns, so some disillusionment is spreading. So what is the economic impact on China and its trading partners? Overestimated?
Going into the end of last year, our base case was that China will reopen around spring of 2023. And this was before China surprised the world by getting rid of the zero COVID policy. And the thing that's noticeable about China, and I had kind of touched on this in my earlier responses, that China did not stimulate its economy in a very significant way through COVID. Their efforts really focused on testing hundreds of millions of people fairly regularly to make sure the COVID wasn't spreading fast. Therefore, our basic expectation, China's recovery would not be a V-shaped recovery like we saw in the West, but rather it'll be a gradual pickup from the bottom. And that's exactly what we're seeing, a rather gradual pickup in the growth rates. And we had also expected the Chinese government and authorities and regulators to administer targeted and very focused stimulus, and not a gigantic stimulus package that one might have seen out of China in the aftermath of global financial crisis, or even after the 2015 RMB crisis. So that's exactly what we're noticing at the moment. And we expect the recovery to continue over the coming 2 to 4 quarters. And we are already seeing signs of increased volume when it comes to things like travel. The purchasing power isn't quite back yet, but as the employment rate picks up and as the recovery picks up, consumer confidence will return, and we expect earnings to come back as well for the Chinese companies.
So, of course, Asian small caps are also subject to global liquidity and credit risk, as well as the generally high level of uncertainty in the market. So what does this currently mean for your stock selection?
Yeah, the one thing we are particularly focused on when we think about picking stocks is, just thinking about a situation we've seen throughout my investing career, which is when there is trouble in the broader economy or in a particular sector, the funding for the small caps really dries up. It could be bank lending, it could be capital markets lending, or it could be equity raising. So having seen a few cycles, we are very focused on picking companies that have one or more of the following. Firstly, they need to have very strong balance sheets so that they can continue to invest in their growth and R&D efforts and capacity expansion, even if there was a downturn, even if the capital markets dried up. And this is usually true for slightly mature companies, but we also invest a fair amount in early stage growth companies. For those companies that are not generating free cash yet, what we focus on is cash holdings. How much cash is there on balance sheet, and how much of their R&D effort or clinical trials or growth capex can they fund over the following 12, 18, 24 months. So I think, those are the two things we focus on, recognizing the trouble some of the small cap companies get into in case of a downturn. And that's really stood us in good stead historically. And that's what we continue to focus on. Not to say that broader macro and liquidity environment doesn't impact our holdings, but we really focus a lot on managing that risk and therefore are positioned well for such a scenario.
The cost of capital is obviously increasing due to a higher interest rate. So what does this mean for Asian small caps? And how do you as an investor protect yourself against possible profit slumps and defaults?
Yeah, the thing to focus on as a fundamental bottom-up investor is really asking the question, what is a company's competitive advantage? Do they have pricing power? How sustainable are the company's margins? Is the given company able to pass on an increase in raw materials, etc.? So that is really an important part of our stock selection process. And we typically invest in companies that are leaders in what they do, and therefore are usually price setters, and not always, but a lot of times. And therefore are in a position to protect their bottom line and margins. And the other piece that we focus on is really to not be engaged with very heavily indebted companies. We do know that rate cycles, come and go. We don't want to be in a situation where, because of excess leverage, all of a sudden your earnings disappear because your interest burden has gone up. And, we don't want to be in a situation where there might even be a whiff of a default. So essentially, we really focus on leverage ratios. We really focus on companies' ability to protect margins and profits, even in adverse economic conditions. Focus on those two things really help us navigate the challenges that you just mentioned.
The semiconductor economy and industry has been cooling down as suppliers from China, Taiwan, and South Korea are experiencing. So what is your take on earnings, valuations, and outlook for the chip stocks in Asia?
I've been in the industry now investing for almost 2 decades. And during that time, we've seen quite a few cycles in technology in particular. One of the things that happens, and this happened towards the end of 2021 and early 22, is that market really got excited with the idea that some of these semiconductor companies have pricing power now and are immune to the cycle. That's driven by this narrative around massive COVID-related supply chain problems and therefore, lack of supply. On the other hand, given the massive stimulus that we talked about earlier in the Western economies, consumers were floating in liquidity and had a lot of spending power. The demand went through the roof. And therefore, some people felt that, this is a new secular trend where semiconductor companies are pricing power. But we took the opposite view towards the end of 2021 and early 22 and took a view that the valuations were exuberant, were not reflecting a potential normalization of supply, and also a potential normalization in this excess demand that happened in 2020 and 2021. And therefore, we had somewhat reduced our technology exposure, especially in names that were trading very expensively. And towards the end of last year, though, we started going back into those names as throughout 2022, the market took cognizance of the fact that inventory was building up and it was factored into the valuations. By the end of last year, we felt like the inventory risk was more than adequately factored into the prices. We actually started buying back some of those high quality names, especially in areas such as memory. We've started seeing signs of the bottoming out, for example. So I'd say, we need to be very selective. We can't make a broad-based statement when it comes to semiconductors, but there are pockets where we feel the inventory cycle has played out, and we are fairly well positioned over the next 2 to 4 quarters in terms of the demand outlook, as well as the inventory correction being over.
India was one of the few equity markets with a positive performance in 2022. So what is your exposure to India, and in which industries do you find interesting investments there?
Yeah, we were overweight India in 2020, 21, and most of 22. But towards the end of the year, the valuation differential between India and China had gone to exceedingly high levels. So we had, took the money off the table in India and then rotated some of that money into China. For the following 4 to 5 months, the relative performance of China was very good. The market had bounced off strongly from the bottom at the end of October. At that point, I felt that India's valuations on a relative basis were slightly more normal. And on a selective basis, we have started buying back into India. However, we position today in India, we continue to like financials, some very well-run companies that had a slightly higher elevated credit costs through COVID, and we address those credit cost issues and very well positioned to grow the coming 2 to 4 years. So we remain excited about the opportunity there. Good growth, very attractive valuations. And selectively, we are in consumer discretionary names, hospitals, for example, and some other consumer staples as well. So it's fairly well diversified exposure to India. And we retain a positive view, especially in light of the capex cycle that we're seeing in India, and the valuations had normalized as well as of 3 months ago. So for those reasons, we continue to remain positive on India.
One of Asia's top long-term investment theme is obviously rising consumption due to higher incomes. So which industry and companies do you currently invest in to benefit from this trend?
Yeah, so that's absolutely been the bedrock of our approach to investing in Asian small companies, this increasing wealth of Asian middle classes. So the way we really have invested in the recent years is focused on 2 different things. Firstly, on consumer discretionary. Disposable incomes grow. People have the wherewithal to invest in consumer discretionary sectors. So I'm talking travel-related services, hotels, shopping malls, restaurant chains, for example, etc. And the other piece that I'm very excited about, have been for a long time, is healthcare. As people's income grow, they want to be able to afford the best class healthcare products and services. And that's really opened up opportunities for innovative biotech companies, medical devices companies, healthcare services companies, and hospital chains, for example. Specifically, I'm excited about those 2 areas. But in addition, we've been investing in financial services. as people's savings go up, their habits change when it comes to investments. And we are positioned very well in financial services as well, in areas like insurance and investment.
So this was Vivek Tanneeru, portfolio manager at Matthews Asia. Thank you very much, Vivek, for being with us today and sharing your insights.
It's been a pleasure, Thomas. Thank you.